Despite high volatility, the situation in the currency market remains unchanged. Given the completely empty macroeconomic calendar, this scenario fits into market rules. In other words, today the Friday scenario may repeat itself. Importantly, this week will be jam-packed with crucial reports on the US labor market. Apart from the labor market data, the inflation report in the Eurozone will be released tomorrow, as well as indicators of business activity of the world's leading economies. Still, the official report on the US labor market will be on investors' radars, so the calendar will gradually be filled with more and more significant economic data day by day. By the way, when deciding on the funds rate, the Fed Reserve will have to rely on the non-farm payrolls for September. After all, the next meeting of the US Central Bank will end on November 7. Updated figures for October will not be released by this time, so the market reaction to the employment reports may be accompanied by increased volatility. The Fed Reserve is widely expected to cut the key interest rate by 50 basis points in November, so markets will be looking for further clues from remarks by Fed policymakers today. They are due to speak at an annual economic forum opening today in Nashville, Tennessee. The report by Fed Reserve Chairman Jerome Powell is scheduled for 17:55 GMT. Meanwhile, the US dollar index has got stuck below the one-year low in the daily time frame. The US dollar index, which tracks the greenback's value against the basket of 6 major currencies, opened today in the intraday corridor between 100.30 and 100.50. In addition to domestic monetary policy, the US dollar is also weighed down by external factors. First of all, the prospects for revival in the Chinese economy pushed commodity currencies to rise to one-year highs. Another factor is the yen's reinforcement. Shigeru Ishiba, who won the elections for the ruling party, is a long-time opponent of an ultra-soft monetary policy. By the way, China also intervened in trading on the US stock exchange. Despite the overall positive week, the S&P 500 and Nasdaq 100 indexes declined on a Friday, mainly because of Nvidia shares. They fell after reports that China had urged local companies to avoid using American-made chips. Overall, however, Wall Street rose for the third week in a row. The S&P 500 index consolidated in the range of 5,727 to 5,764 points at the start of the busy week. Interestingly, the European currency, which often correlates with the US stock indexes, does not fit its image today. The euro began to rise sharply. The reason for its rally was inflation reports in Germany. All 6 federal countries looked growth from a month ago. As a result, the euro-dollar pair not only excited the stagnation stage, but also resumed the overall uptrend. Besides, the buyers were even able to break through the round resistance level of 1.12 below. The bulls need to settle the price above this landmark level to extend an upward rally. Moreover, this must be done during the trading day. Then the bulls will be able to prolong the rise in the euro-dollar pair towards the high set in July 2023 at the 1.1276. Otherwise, the main currency pair will again get stuck in the current range of 1.1158 to 1.1212. Gold is on a track to finish its best quarter in 8 years. In the third quarter, the metal jumped by more than 14%. Moreover, in September alone, gold prices rose by more than 6%, recording peak values around $2,685 per troy ounce. The main growth drivers were a sharp rate cut in the United States, planned measures to stimulate the Chinese economy, and the escalation of tensions in the Middle East. Crude oil prices remained stable despite the ongoing tension. in the Middle East. Today, Brent futures slowed the downward cycle at about $70 per barrel, so traders increased their long positions. However, this reversal has not led to a shift in overall trading sentiment. Traders still consider the bearish scenario as the baseline one. To extend the further drop, Brent prices need to settle below $70 per barrel level. Until that happens, the price is likely to trade above this level. According to the OPEC Plus agreement, oil output rates are set to be pumped starting from November. However, a recent statement from Saudi Arabia indicates that the kingdom is preparing to increase production only starting in December. The reason for this delay is the speculative pressure under which crude oil is now trading. If the market does not correct itself, oil exporting countries may resort to strict measures. And in this case, crude oil is likely to face price chaos. So, what about Russian currency? The ruble is going through troubled times. Last Friday, the ruble plummeted, and the cause lies in geopolitical factors. Starting from October 12th, the U.S. Treasury Department's full ban on operations with the Moscow exchange will take effect. As a result, the People's Bank of China has stated that a halt in yuan trading on the Moscow exchange cannot be ruled out. However, the monetary authority of both the Russian Federation and the People's Republic of China now are working to ensure that exchange trading proceeds as usual. Nevertheless, the risks of negative shifts for the ruble remain very quite high. Firstly, it has triggered a surge in demand, and secondly, given such statements from China's partners, the ruble is expected to lose in value. And we see amid worsening prospects the yuan-ruble pair showed the high speculative activity by the end of the last week. From a technical analysis point, the ruble is extending its weakness. So the yuan-ruble pair is expected to rise if the instrument settles above 13.30. It could signal a new wave of long positions. And in the future, this could push the price toward the local high of the uptrend. An alternative scenario suggests a weakening of the speculative sentiment, which could once again lead to price fluctuations around 13 rubles per yuan. So that's all for now. We continue to follow developments in the financial markets. We wish you profitable deals. Subscribe to our channel and see you soon.